Hey everyone, I wanted to go over the SPY chart and review the action from today's trading session. The market opened pretty well. As I had expected, we would go ahead and challenge this resistance line, the 210.50 resistance line. So let's go ahead and take a look at the 5-minute chart here. So the market opened up and we quickly rallied to 210. As in my last video, I said 211. 211 would be an options resistance. There's about 38,000 calls sitting at this level. So quickly, the price got rejected at this level. Now that's fine because normally it would take some time for resistance to wear down, and that's not a problem. But what is a concern for me is the last hour of trading when we had this huge sell-off on huge volume, and that reversed today's action from a green day to a red day, and that was a concern for me, especially on the huge volume. A close above 210.30 or above Friday's closing price would have been, good sign that things were normal, but this is a cause for concern. After studying the chart some more, I also saw this pattern coming out, and when you look at charts, over time you're going to start seeing more and more patterns that kind of confirm your bias. And this here is a rising wedge chart pattern, and it's a bearish chart pattern. As we get to the nose of this rising wedge, we're going to expect that price will eventually start breaking down. And if you look at the time frame, we assume maybe we can either break down here or in this area. You're going to look at the late April to late May time frame where we can go ahead and break this pattern. So it's another bearish pattern on the chart. I've already discussed several others. Let's go review those real quick. On the daily chart, if we have a pullback here, if we're not able to break above the 210.50 line and close above it and make a new high above this candle here, we could possibly pull back here to the 10-day line. But by doing that, we're going to form the shoulder of a head and shoulder pattern. And we might get a bounce off of the 10-day line. We'll have to see the quality of that bounce if volume comes in and we get a big price action to the upside. If not, it's a small bounce. We could easily go ahead and head back down to this trend line, and this is the rising line, for the bottom rising line of the wedge. So you have two bearish patterns converging, and that's not a good indication for the chart. Now what other options could happen is we could go sideways here for a while, let the 10-day catch up, and then bounce off of that one area, which is around here, and go higher. So that could kind of ward off the head and shoulder pattern here. Now what I like to hopefully see tomorrow is that we finish this lightning bolt type pattern where we get a big candle, a pullback here, and then boom, another bolt up higher. But with all the bearish signals, I'm not as confident as before. Now, if you take a look at this chart here, though, there's a very high possibility we can head higher into the 214, 215 area, because that's the upper trend line here. Now, if we start heading back here, this would be where the break of the head and shoulders is, and we can see more downside here. So that's what the head and shoulders is the second bearish signal. The third one is this ultra bearish stochastics divergence that I talked about. Now this one, so far we have not invalidated it because we have not made a new high here, and we have not crossed this line on the stochastics. And this is ultra bearish because it usually precedes a significant pullback in the 20 to 30, even 40-50% range on on indexes and also on individual stocks. If you want to see how this plays out on the indexes and some stocks, you can check out my previous SPY videos. Search for ultra bearish or bearish divergence, and you'll find the video. But this signal here is still in play. Now, I told you this is a more intermediate term. So if you went ahead and took this out, say 100 days, which is right here 98 days, you're going to see that it's roughly the same time frame as the rising wedge pattern. Here is June 1st. If I brought it out 98 days, if we bring it back to 90 days, that's May 25th time frame. So the time frame for these signals are also lining up. So not a good not a good indication here. The last bearish signal, and this is a new thing that we kind of talked about in the last video, that we made an observation that when the 10-day line is approximately 20% away from the 50-day line, we get the 10-day possibly pulling back and crossing over into the 50-day. This one is not a very strong signal in the sense that I haven't looked at it in many different contexts. We only have one data point since this is the monthly chart. Actually, we have two data points. One was a 14% extension from the 50-day, and the other was a 21% extension from the 50-day. So this one is about near the 21%, and that had a pullback. So this could be also another signal or indication. So that's what I'm seeing in the market. We have the risk-reward ratio now is not looking as good as before. We have tiny upside, but we may have a significant pullback in terms of bear market. We have maybe a 2% upside here, but we could easily get a 20% pullback, which would bring us really all the way back, maybe even past the October lows here. If you do the head and shoulders measured move, at the very least, we're looking at a pullback to the 190.43 area. So definitely something to keep in mind. It's looking more bearish for the market. If the market does turn bearish, always keep in mind that breakouts are more likely to fail. You don't want to get into a whole bunch of breakouts that are more likely to fail. And anything that you've had gains on in the last few weeks, stocks like On Deck or Facebook or CSIQ, you might want to start taking profits once you start seeing sell signals. You don't want to give up all those gains and then go negative after having a big gain. So that's it for this video. If you like what you see, please click on the subscribe button below this video, and you'll get notifications when I put out new videos. So thank you for listening.